Well, I think a lot of the issues in the oil market are structural, meaning in a lot of cases where you have too much supply, which you would do if you're producing too many autos and the price of autos is falling, you close the plant. The problem with oil, the nature of the commodity is it's difficult to shut wells, because if you shut wells, you lose pressure, and the wells may actually then become somewhat extinct. So I think some of this is technicals in the energy market. But to your point, look, is this going to have a profound impact on areas like Houston and the oil patch? Absolutely. But I don't think per se the oil problems, which I view a lot of technical in nature, are going to have a long-term lasting impact on the U.S. economy.
Okay, perhaps the fear in the market, though, Kirk, is that it's coming at the same time where we're already having such a profound impact due to the coronavirus. And we've learned a lot more from some corporates this week, whether it's Coca-Cola, IBM, all reporting, giving us an indication of what they expect. But it's still so hard to predict. Is there anything so far in the earnings season that has forced you to change your investment strategy?
Well, no question. I mean, we're getting so used to 500, 1,000 point swings in volatility in terms of the market. I think what's interesting to me, the Fed in both the equity and the fixed income markets has drawn a line in the sand. The secondary market purchase program the Fed put in place last week, buying bonds that have fallen from triple B to double B, entities like Ford or Boeing, is a dramatic change in addition to buying high-yield ETFs. So in my mind, the Fed said, look, we're going to support big companies, well-capitalized companies, and companies that are more than 6 times levered. We're going to let them have their problems. I would argue similarly in the equity markets, the S&P is down 12% year to date, but small caps are down 27%. So I think both markets are very reflective of what I call the Fed put and the government's indication that it will support the vital areas of the economy.
That's right. Kirk, when you talk about supporting the vital areas of the economy, especially extending out support to the oil industry, we were just flagging this graph that highlights, this is of course source-based and based from data shared by Ristad Energy. They're talking about how at $10, $20, you would have like a few hundred companies within the shale gas industry going belly up over the course of the next 12 to 18 months. Who will absorb the impact of all of that? Because one would like to believe that all of it will filter through to some of the bigger names as well, like Chevron and ExxonMobil, that have already cut capital spending.
Well, no question about it. I mean, look, clearly investors and hedge funds and speculators in the energy space are going to be hurt. To your point, we're expecting a number of bankruptcies to come in the energy space. There's going to be a lot more mergers, a lot more consolidation. So I think it's way too early to try to play the rebound in energy, which is why you saw today with the USO ETF, which got absolutely clobbered. A lot of retail investors were speculating on that. But look, it's not good in the energy space. I mean, energy credits in the fixed income area don't trade on spread, they trade on price, meaning 50, 60 cents on the dollar.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.